The U.S. stock market rallied furiously here today, with the Nasdaq up over 2%. Remember that the day after tax filing deadline here in the United States tends to be a bullish day, so that kind of followed through nicely on that statistic here today. But it was a broad-based advance with nearly every sector participating with the exception of energy. They took the rare day off here today. But we had 88% of market components closing in the green here today. However, after hours, we did hear from Netflix, and that stock is down 20 to 25%. So there is a chance that that growth-oriented NASDAQ area struggles a little bit first thing tomorrow morning. Otherwise, today's rally did wonders for our posture, and we'll talk about that in tonight's video. And then I want to get into the trade application example that features a rare or undiscovered, unknown agriculture play that is bouncing up and off of its rising 30-day moving average that might be setting up for a nice bullish swing trade. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's April 19th, 2022. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below. Make sure you're signed up for our email distribution list, so that way you can be notified whenever we post these videos. We also give you the heads up of any stocks giving you overbought or oversold cluster signals within the S&P 500 at the bottom of those emails. We're also heavy users of Twitter. If you're not doing so already, I would encourage you to follow me at Brandon Van Zee. We really appreciate those of you that click like and retweet on these Market Outlook related posts. And then last but not least, we do have a presence on Facebook as well. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And let's get started here with our heat map of the S&P 500. And as you can see, it was a beautiful day if you were long the stock market. In fact, we had about 88% of all the components in the S&P 500 that managed to close in the green here today. Really the only consistent exception to that would have been energy. Of course, energy being the leading area of the market for the last several months. Today it took a bit of a breather as the oil market and commodity markets in general sold off just a touch. And we did find that money was kind of rotating into growthier types of areas out there. But you did see your typical Chevrons and your Exxon Mobils and your Conocos. They were down about 1 or 2% a piece there. Phillips 66 managed a nice little increase here today. That's a stock that we've been concentrating on a little bit more recently. Earlier this year in my dividend growth investing class, so happy to see that one up a little bit more, but otherwise mostly red there in the oil patch. In terms of areas that had a little bit more red than others, they were probably more one-off stories. Twitter, as an example, was down about 5% here today. Remember, Twitter has, of course, been caught in the crosshairs of potential takeover talks by Elon Musk and perhaps other private equity players. So there's kind of rumors floating in and out on whether that deal could theoretically get done or not. And so today was a little bit of a give back from all those gains that it had in recent weeks. We saw Lockheed Martin struggling here today as they had their earnings announcement there. We also saw Pfizer struggling here today. Perhaps some of the news about lifting the mask mandates and things like that are making people kind of think beyond COVID. Now, one square that you don't see lit up in red that was green on the regular session was Netflix. As you can see here, as I'm kind of pointing with my mouse, Netflix was up 3% here in the normal session today. However, we are now in earnings season, and my oh my, did they drop the bomb after hours. Netflix came out and highly disappointed Wall Street, had lost like 200,000 subscribers or something along those lines worldwide. And the stock market is not treating it too kindly at this moment. Last I checked, it was down somewhere between 20 and 25% after hours. So brace yourself if you are a shareholder of Netflix. Tomorrow is going to be an ugly day. And not a whole lot that you're going to be able to do about that. Even some of those tertiary plays within the streaming areas like Disney and Roku are also trading down after hours here tonight, about 5-6% or thereabouts. I saw that Paramount Global, one of the big media companies, is down pretty considerably here after hours. Even the new Warner Brothers that was kind of spun off as part of the AT&T division, it was down after hours. So this is going to be a big event tomorrow for a lot of media-related names. And again, the reason behind that, Netflix came out and surprised everybody negatively to the downside and is seeing their stock price take quite a considerable hit here. In fact, as I was stating on Twitter here a moment ago, Netflix, with where it's trading after hours right now, has actually completely erased its entire COVID-related gains. Remember, for a while there, COVID was the reason you would own Netflix, with everybody kind of locked up in their houses, spending a bit more time indoors and away from crowds. There was a lot more streaming of Netflix movies and things like that. But just like that, snap of the fingers, all of that has evaporated. Now you are actually seeing levels on Netflix lower than where you were at the lowest levels of the COVID crisis. And so I think you're kind of back to like late 2018 levels with where it was trading after hours. You can see here as I'm pointing at it, the last closing price today was $348, but where I last saw it trading in the after hour session was $260. And so no, that is not a mistake. That is a haircut of approximately $90 per share after hours right now. So that will be likely the big story as we go into tomorrow's trading session. In terms of where we saw bullishness today, we didn't have to look very hard. It was all over the place. But naturally, some of the bigger squares and rectangles catch your eye a bit more. So Amazon had a nice day. It was up 3.5%. Tesla was up over 2%. Johnson & Johnson had a nice day. That's not a name we talk about quite as much. There's a little bit of a quieter company there, but of course, not only a dividend aristocrat with 25 years in a row of increases, but they're one of the rare dividend kings out there as well, with more than 50 years in a row of increases. In fact, that was part of the reason that the stock was up today. They announced their 60th straight dividend increase over the last 60 years. And I think the increase was approximately 6%. So not too bad when you're talking about an old line company like that for long-time shareholders like many of you that have been to my classes over the years very well might be. So a joyous day for Johnson & Johnson shareholders there. But really, as I mentioned before, we had bullishness all across the board today. So good chance when you open up your account statement here today, as long as you're long the stock market, you probably have a smile on your face. Let's go ahead and mosey on over to the other part of the platform now. Take a look at our market breadth measures here. And as you can see, I've got the index watch pulled up with the visualize sub-tab under the market watch main tab. And I've got the S&P 500 index pulled up here to kind of break down how many winners did we have versus how many losers did we have here today. And you can see that there were about 441 stocks in the S&P 500 that closed in the green here today. So that was where I got that 88% number that I had mentioned before. So only about 12% of components within the S&P 500 closed in the red today. And I would imagine a fairly large chunk of those were directly within the oil and gas area. So it was one of those lopsided days. And fortunately, it was a lopsided day for the bulls here for a change of pace. It seems like we've had more of those lopsided bearish days in 2022. But today, the bulls did earn themselves a nice victory. As we can see from this chart, 6D, I like to pull this up whenever we have at least a 1% move, either up or down. And today was one of those big up days. As you can see, this green candle here is up well over this horizontal blue line with the 1 next to it. That stands for a 1% move. So you can see the green bar did not quite tower up here to the orange line to get a 2% move. Nonetheless, it was an aggressive day where we were up 1.61%. And you can see that continues our streak of pretty exaggerated trading that we've had here for really the last 5 months. As I look at this kind of middle area of the chart here to show us both the up movements of the market on any given day and the down movements with those red bars, you can see how exaggerated both up and down the red and the green bars are, starting about right here. Right around Thanksgiving. It seems like there was a change of tone within the market, and now we've experienced a lot more heightened volatility during that time compared to what we had been experiencing for the 6 or 7 months prior to that. And you can kind of see that to a degree with the VIX down below as well. The VIX is that purple line, and obviously we've had a lot more of these big VIX spikes that have been taking place here in the last 4 months compared to what you saw back here, which was kind of a lull you to sleep type of a market where there just wasn't a tremendous amount of volatility. We were just constantly going up gradually, pulling back, going up gradually, pulling back, going up gradually, pulling back, and then eventually we kind of turned into this more chop and slop type of a market that we've been dealing with here, where it's been much harder to get consistent gains to the long side of the market, unless you were lucky enough to have a whole bunch of oil and gas companies in your portfolio. But besides that, it has been much more difficult out there. Now, obviously, there are ways that you can still make money bullishly, even if you have these kind of choppier types of markets. Many of you know that I've been putting on lots and lots and lots of sold put trades in recent months in this market, and most of them have come up on the winning side of the equation despite being bullish trades, because I'm giving myself that flexibility by selling the out of the money puts to be wrong initially and be able to absorb a further move lower. It's just that I can't have a collapse lower after that. So I think those of you that have been practicing the mindset of selling puts on high quality companies that you want to own at lower prices anyway, that's one way where you've been able to get through this little bit more bearish time period that we've been dealing with without having gotten all that roughed up by the market like a lot of other people who are much more aggressive on the bullish side probably have been. So I guess that's the good news when it comes to these market outlook trades that I've been teaching you here more recently. Let's go ahead and take a look now at our normal foregrid. And this is chart 4B for those of you that are premium members following along at home with your own charting package. And we had a very impressive day today across the board, not only from the amount of gains that we received, but notice the impact on the chart background colors as well. So starting with the chart in the upper left-hand corner, this is the S&P 500, as mentioned before, up 1.61%. You can see that all of these daily range labels in all 4 of the charts are orange, telling us that we had an above average range day compared to the typical average true range. So basically what that means is today's high to low trading was more aggressive than your average days that you've had here more recently. And while we see that quite often on sell-off days, it's a little bit more rare to see the exaggerated movements on the big bullish days. But it was nice to see that here. We started extremely low on today's candle, which basically the open represented the low of the day. And we spent the entire day rallying to nearly close at the extreme high end of the candle. So there was a lot of bullishness, pent-up bullishness, that helped that candle not only get up to the moving average, but as you can see, the moving average changed colors here today. It's now green. Yesterday it was yellow. So yesterday price was below a rising moving average. That moving average continued to rise, but the difference today is price is back above it. So not only do we have a green moving average, and this is a 30-day moving average here, but notice the background color of the chart has also now turned green. And the reason for that is because of what we see down below here on the market forecast technical indicator. We were in a little bit of a pullback mode here with that intermediate line, but with today's big rally, just like a lot of technical indicators, it's a lagging indicator. It's going to be using inputs, not from the future, but from what has happened in the past. And now that today is in the past, or at least today's trading is in the past, that has made an impact on the technical indicators. And today's aggressive bullishness was enough to actually reverse course with this intermediate green line on the market forecast technical indicators. Probably hard to see with the naked eye here, but it is accurate. The reading right now is at 54.28, and yesterday's reading was at 52.20. So in other words, after today's big stock market rally, the green line on the market forecast for the S&P 500 is 2 points higher today than it was yesterday, and therefore that means that this line here is kind of rounding a corner and heading higher again. Now, remember, we're at a little bit more of a precarious area here because we basically are stuck somewhere in the chart or in the indicator's mid-range there, around the 50th percentile. So remember, the further away you are from the 80th percentile, the greater the chance is that this could be a head fake. I'm not here to say that it is. That's why we look at the evidence every single day to try to determine that as time goes on. But I'm just saying that if all of a sudden tomorrow we completely erased all of today's gains, you could easily see that green line go back to a bearish posture. So we shouldn't get overly comfortable with this, but I did like the way that it played out. If I'm being honest with you. And the reason for that is we had this nice burst of energy back here in the latter half of March, and then we had this give back time period here where we stabilized at the 30-day moving average, and now today all of a sudden we are trading at our highest level since going back here to this candle, right? Because we closed at the highs of today's candle. That was higher than on that candle where we also closed near the highs, and of course these other ones back here we closed near the lows. So all of a sudden we find ourselves at 1 week highs as a result of one single day, and we're getting it at an area where you would anticipate a bounce happening anyway, where we oftentimes find that 30-day moving average to act as a reasonable support launch area right there. The other thing that I find somewhat interesting from a calendar perspective is April is typically a strong month, but what we have found is that sometimes in early April, we don't really have the same strength as what we typically witness in the later part of April. And in particular, the day after the tax deadline has become known as a quite bullish day on average throughout the years. And of course, yesterday was the tax deadline, and so today is that first day after it, and it kind of, comes through once again. Sometimes, I mention those statistics that I have here on my desk calendar with the Stock Traders Almanac, and you'll notice if you have an issue of that as well, that it says right there on Tuesday the 19th, April exhibits strength after tax deadline in recent years. And so it was good to see that kind of played through. And you could kind of get an impression as to why that might be the case. Once people have paid their taxes, they now know what they owed to Uncle Sam or wherever you pay your taxes, and now maybe they have more of an ability to spend any excess cash that they still have, if they didn't pay it all to Uncle Sam, on the stock market, and maybe investors become a little bit more confident in their own cash flows the day after tax day. So, good to see that kind of theory played itself out nicely here today as well. So back to a strongly bullish posture on the S&P 500 and prices above that rising 30-day moving average. With the Dow Jones Industrial Average, it was up 1.45% today, so it was the laggard. And remember, that's often the case. Whenever we have the biggest, most robust up days, the Dow Jones tends to have a hard time keeping up with the more speculative indices out there. The Dow Jones is kind of your big, bulky giants of the world, Procter & Gamble and Johnson & Johnson and Coca-Cola and those types of companies. And so while it has the benefit of typically not going down as aggressively on the worst of sell-off days, it has the opposite impact on the big up days where it doesn't have the ability to quite keep up as easily either. But still, a very good showing out of the Dow Jones today, and in fact shares those same qualities that I just mentioned there with the S&P 500. We are back to a strongly bullish posture on the Dow Jones with that background color changing green once again. In fact, I would give them the edge in this conversation where they are currently this market's leader. They weren't the leader today, but in an extended, multi-week thought process, they are the leader. The reason I can get away with saying that is because the intermediate reading is at 69, and it is higher than all of these other intermediate readings that we have here. So the Dow Jones stands the best chance of getting its green line back up into the upper reversal zone above 80 because it's closest to it right now. And so you'll even notice that on the price candles up above, notice the difference on Dow Jones Industrial Average versus all of these other charts. All of these other charts cut below the moving averages. The Dow Jones did not. It touched its moving average a couple times right here, but it used it as that support launch here today, and it never did close below that moving average, right? So that's the difference. With these other charts, you're getting that red and that yellow showing up here on the moving averages themselves, but we stayed green this entire time here on the Dow Jones Industrial Average. You had this really weird candle right here that led to one day along the way with a yellow color as a result of a quick little bend lower in the moving average, and then immediately the next day it bent higher again. So that was kind of almost more of a glitch than anything. But I would basically say that this last 2 to 3 week period, you've seen the Dow Jones stay above its rising 3-day moving average, whereas you cannot make that claim with the other charts. So that's the good news there. On the two bottom charts, we had equally as aggressive trading here on the upside as well. Today's leader happened to be the NASDAQ composite. Remember, that was an area that had been the most out of favor during this kind of 3-week pullback that we've been experiencing. So it makes sense that what had fallen the fastest is the one that will rise the most aggressively if we have kind of a rebound day. Sometimes people refer to that as a possible dead cat bounce. Don't kill the messenger. It wasn't me that came up with that. I know for all of you cat lovers, I'm a dog guy, but pet fan in general, so nothing against cats out there. But sometimes you'll hear people refer to that as the dead cat bounce, and it's kind of meant to suggest that it bounces the highest off the ground, but it may not last because there's still a lot of negative energy within the chart. So you can see here that despite the biggest move today on the NASDAQ, up 2.15%, it still wasn't enough to get back above its moving average, right? We just got done saying the S&P 500 and Dow are nicely above their moving averages, and they didn't go up as much as the NASDAQ today. The NASDAQ went up tremendously, but still couldn't get above its moving average. The good news is the moving average is rising, but we still closed just a hair below it. So that's why it remains yellow as opposed to green and green like we saw with the other two. The good news is that the posture, the market forecast posture, did shift to weekly bullish here today with today's aggressive move to the upside on the NASDAQ. Remember, with the S&P 500 and with the Dow, notice how the dark shade of green appears. Down below here with the NASDAQ composite and also with the Russell 2000, it's that lighter shade of green. And the reason for that is because the green line did reverse higher, just like the other two that we mentioned, but because they now find themselves below the indicator's 50th percentile, we consider them just weakly bullish as opposed to strongly bullish. So, the NASDAQ is close enough at 43. It's not all that far away from the 50th percentile where it could easily get to a strongly bullish posture within a couple of days if it has another couple of big up days. But remember, tomorrow might be a difficult day for the NASDAQ because of what's happening with Netflix after hours here. So I'm not sure that's going to be in the cards knowing what we know at this moment in time. But theoretically, it's close enough to that 50th percentile where it could get back to that strongly bullish posture within a pretty short amount of time right here. With the Russell 2000, it's kind of same set of circumstances where it had an aggressive day today. It was up over 2%, just barely 2.04%. But even with that aggressive move, it's still below its moving average at this moment in time. If it could have gone up another 0.5%, that wouldn't have been the case, but it stopped just short of closing above the moving average. So if tomorrow's an up day for the small caps, there's a good chance that its moving average color would change to green, but there's a very good chance that it'll stay with the light green background color of the chart, because even if it goes up tomorrow, the green line is way down here at 36, so it's got a lot more work to do to get up to the 50th percentile, as opposed to what we just got done saying there with the NASDAQ. So could that happen? Sure, but it might take a little bit more time than it would take the NASDAQ. So we'll keep our eye on it. But the good news is this. We had really aggressive bullishness here today across the board, right? The only area that was left behind was the oil and gas stocks. And believe me, they got plenty of gains to give back. So we don't have to cry any tears for them. But the rest of the market, all the other 10 sectors, erupted higher. And this was an aggressive range day where we closed near the highs of the session. And this was a big enough up day where the postures, the intermediate postures, all changed on the same day from bearish back to bullish. And again, be cautious around the NASDAQ and tech-related names with what we know right now with Netflix after hours. But, with that as an aside, today was a very important winning battle for the bulls, and I think they kind of drove their stake in the ground and said, hey, we want to try to rally from this level. Let's see if we can build upon it. Let's go ahead and pop on over here to the internet briefly. I always like to get a chance to say thank you to those of you that help support this free video on YouTube. And the last time I did the video there on Thursday, just before the holiday weekend, 106 of you stepped up to the plate and clicked like for me there. As you know, as long as we're getting up and over 100 likes, I'm happy to do the full-length video, including the trade application example for you the next time I'm scheduled to do the video. If we're below 100 likes, then I'll just keep it short with a 15-minute quick hitter video with no trade application example. So I let you guys vote collectively as to what you appreciate. Some of you like my lengthier presentations. Some of you say, you know what, Brandon, it's a little bit too much. I could get away with just the basics there as well. So in the end, we'll let you guys decide through your likes. As you were up and over 100 this time, obviously I'm doing a full-length video. And so if you want me to do a full-length video for you again on Thursday, make sure you click like. It only takes 5 seconds out of your day, and that's a heck of a good trade-off or a good deal for you, because these videos take us over 3 hours to produce. And so if you want access to our time, we ask one simple thing from you, and it's not even any sort of a monetary payment. It's just simply to support us by clicking like there on social media, especially on Twitter. And thank you to the 106 of you that did that for me over the weekend. That goes a long ways in our book. Keep up the great work there. In fact, I would also say this, to my recollection, I don't think there has been a single time I've done the video in calendar year 2022 where you guys have not gotten up and over 100. I think there was a couple times where we got to only like 101, but nonetheless, I think you guys have a perfect win streak in that regard in this calendar year 2022. So keep it up. Let's do our best not to break that streak. Also earlier today, here in our premium classes at Market Scholars, we were busy as we always are. I taught my dividend growth investing class, and we had a great conversation using some charts that I typically don't bring up in that class, referencing longer term analysis and some of the statistics around holding periods and rolling time periods and your odds of success as a long-term investor, despite all of the terrible things that have happened in the world over the last several decades, World War II and Vietnam and, the terrorist bombing in New York and, or not bombing, but, the 9/11 tragedy. And, we've had bombings in other areas, Oklahoma City and different things like that. A lot of terrible things have happened in the world that could convince you as an investor to get out of the stock market. But generally speaking, the stock market has done nothing but printed money for people who have stayed the course throughout history. And again, I know that's a little bit of a different conversation in this venue here, because most of you listening to me right now on the YouTube video are traders and short-term oriented. But for those of you that are long-term investors, just keep in mind that I do teach long-term investing classes here at Market Scholars. So if you're interested in that commentary and the trades that we place in those classes, make sure you're joining Market Scholars Premium. And I think you'll enjoy enjoy that experience. Today, we concentrated on the financials sector, as a lot of those financial stocks have been beaten up here in recent weeks. Many of them have now found themselves with quite attractive dividend yields, and so we scooped up a nice candidate here earlier in class today. So feel free to watch the recording there. David taught his directional option strategies class. Remember, that's a short-term oriented class. But rather than buying stock in it like I would in a swing trading venue like I'll be teaching tomorrow morning, he uses options to get directional within the market. And so if you're interested in that commentary, David does an excellent job, and should get that recording posted here momentarily. So tomorrow we'll be back in action. I'll be doing the factor-based swing trading class at 11 a.m. Eastern Time. And then David will be doing the options inventory trading at 2 p.m. Eastern Time for those of you that want to try to make money on neutral, sideways, chop and slop types of markets, selling iron condors and doing diagonal spreads and all that kind of stuff. That's perfect for David's wheelhouse there, and you'll learn a lot, I can assure you of that, by attending his classes. Let's also talk about our sector selector tool. Now, I update this on Friday evenings, typically. This past time, I actually got it done a little bit earlier than I normally do, simply because the stock market was not open on Friday, so it gave me an opportunity to get it done a few hours earlier than I typically do. But point being, it's a couple of days stale at this point, but can still give us a good understanding of any rotations that we might be seeing within the marketplace. And for the third straight month, energy did remain number one. And we got to give credit to utilities here as well. They probably don't get the press that the oil and gas stocks do, but utilities have done a masterful job staying relatively strong for the last month and a half. You can see that in the last 7 weeks, they have been ranked number 2, just behind energy, each one of those 7 weeks, with the exception of right here on March 25th. They fell down to the 3rd slot that week. But, for the most part, they've averaged being the 2nd best performing sector out there. In fact, we concentrated on the utilities sector yesterday in my top-down trend trading class, and I noticed that the stock that we bought was up over 5% today. So happy to see that. Obviously, it doesn't always work that way. The week before, we actually got stung by a stock that we bought, and it immediately went down. So it works both ways, but I was happy to see that the utility stock that we bought just yesterday morning was up 5% here today amongst this quite bullish market that we have. So if you're interested in that, feel free to check out the recording there if you're a premium member. Consumer staples stayed at number 3 for the 2nd straight week. They're kind of getting the benefit of some of the defensive characteristics. And then materials went up to the number 4 slot right there, as a lot of those commodities have led to superior profit-making opportunities within the metals and mining companies and different things like that. I would also point out that industrials did go higher here today, or I should say week over week, from the 8th slot up to the 7th. Normally, I'm not going to specifically point that out, but because my trade application example later on in tonight's video will be from the industrials space, and it will be a bullish trade, I just figured I would point that out as supporting evidence there as well, where we're getting a little bit of a push into the industrials on a comparative basis here recently as well. You can see that the financials that I had mentioned before have fallen to their lowest level in the last 3 months. And so we were enthusiastic about sifting through the rubble in today's dividend growth investing class, because remember, if you're a trader, you probably want to concentrate on what's relatively strong. That's the top of the sector selector. If you're a long-term investor and you're planning to hold stocks for years, if not decades, then it makes a little bit more sense to concentrate on what's at the bottom of the sector selector, because that's where your beaten up stocks are that offer the best value opportunities. And so financials, after being strong 2.5 months ago, now have found themselves kind of in the penalty box here from a relative strength perspective. But of course, as stock prices fall, dividend yields go up. And so as long as those dividends are not likely to be cut, they are more attractive when the stock prices are lower than when the stock prices are higher for long-term investors. So depends upon who you are. If you're a trader, concentrate up at the top. If you're a long-term investor, then perhaps there's opportunities with beaten up merchandise down there towards the bottom. Let's get back on over to the Thinkorswim platform and let's do some 12 grid analysis. Starting with chart 5A, this is our asset class 12 grid. This will give us a general sense as to what's been happening across the different financial assets in recent weeks. Remember, the green background charts are the ones that have bullish intermediate postures according to the market forecast technical indicator. And then the pink charts, of course, would be the bearish postures according to the market forecast indicator. So at the bottom rung, we do have 3 out of the 4 that remain with that green background color. Remember, we talked about that when I did the video on Thursday. At that time, gold also had a green background color, so there was a clean sweep on that bottom rung. But as you can see, the last 2 days have not treated gold particularly well. Gold was down 1.5% today, and not only did it change the background color of the chart from green to pink, but you can also see that it had an impact on the moving average. So this is fairly rare. More often what you'll find is kind of a transition period when you go from green to yellow to red on the moving average, but this is a kind of a rare instance where we went directly from being green on yesterday's close to being red on today's close. So not only was it a down day for this asset class, but it was an aggressive enough down day where it actually moved the moving average from going up to going down. That's what that's telling you, right? Yesterday you would have had price above a rising moving average. Today you now have gold's price below a falling moving average. So that's starting to look maybe a little bit more concerning there all of a sudden. We don't want to make too much of it because this is the first day below the moving average, so maybe it's just taking its time to stabilize. But considering the fact that you had the posture change and the color of the moving average change happening on the same day, I think it is worth at least paying attention to. Oil was also down today pretty considerably, over 4%, but unlike gold, it did maintain its strongly bullish intermediate posture there. And part of the reason for that is it had just been stronger in general, right? If you were to look at these numbers off to the right-hand side here, I don't really address those all that often, but I think it's a good case in point here to make sure you're all aware of what you're looking at. But these numbers that are listed in the bubbles to the right of the charts of these 12 grids are the percentage returns of that particular ticker symbol over the time period of these charts, with these charts all representing 3-month time periods. So gold over the last 3 months is now up just 5.66%, whereas oil, despite today's 4% give back, is still up basically 26% in the last 3 months. So in other words, oil has done a lot better than gold, and so it can afford to give back some big chunks along the way because it out-earned with really big chunks on the upside as this trend was developing along the way as well. But I would say the same thing, that it's still important to kind of pay attention to this move today, because while the price is still above its moving average, notice the moving average color did change from green yesterday to yellow today. And in this instance, what that means is price is now above a falling moving average. Yesterday and those other days before it, price was above a rising moving average. But because this entity fell over 4% today, similar to what happened with gold, it was a big enough move where it actually bent the moving average lower. So, that's kind of stands out to me like a sore thumb. It's not very typical for that type of behavior to take place. Now, what hasn't changed, so we now know that the commodities have changed a little bit here today with a little bit more bearishness embedded in them than what we had recognized last week. What hasn't changed are the bookends of that bottom rung. Off on the left-hand side here, the US dollar rallied yet again. We are at multi-year highs on the dollar. It was up another 0.22% today, and as you can see, clearly above all these other price candles over the last 3 months. And the same thing is happening with treasuries over here on the right-hand side, or treasury yields, I should say, on the right-hand side. In fact, we talked quite a bit about this in my dividend growth investing class today, saying that, 10-year treasury yields are now becoming quite comparable to dividend yields that are out there from healthy blue chip companies. Now, obviously, dividend yields are not directly comparable to fixed income because fixed income doesn't raise their income to you, whereas dividend stocks do raise their dividend on a fairly regular basis, as I mentioned earlier there with Johnson & Johnson having come out with their 60th straight increase today. And I also posted about Travelers increasing their dividend today. So, that's the good thing about dividend growth stocks is that they can raise the shareholder pay directly, whereas bonds don't do that. So, they're not directly comparable, but sometimes people make trade-offs and they say, well, I need a certain amount of income out of the market this year. Do I want to get it out of the bond market or do I want to get it out of the stock market? And in recent years, the answer to that has been pretty straightforward. You've been able to get next to nothing in terms of yield out of the bond market. So the answer had typically been go to find a stock that can find that type of a yield for you. Today, we're not really having that conversation as obviously because now we have the bond market offering approximately 3% yields for people who are nervous about stock market valuations or whatever is going on in their life, right? If you gave the U.S. government your money for the next 10 years, they will give you 3% yields each year along the way in income streams, and then they will give you all of your money back in 10 years, assuming the U.S. government does not default. Whereas the dividend stock world does not offer such guarantees, right? Dividends have the benefit of having the companies themselves raise that shareholder pay to keep up with inflation through dividend growth over time, but the company's stock price will be quite volatile along the way, so you kind of have to earn your keep there. And it is possible for a stock to cut its dividend, as we heard from AT&T over the past year as just one example there. So, there's always that challenge of figuring out what's best for you. There is no perfect way in the world of investing. The best is to try to find a strategy that fits your personal situation and really your personality and your temperament. We talked a bit about the Warren Buffett interview that was done on Charlie Rose that I tweeted about over the weekend. We talked about that a little bit more in class today as well. And of course, Warren Buffett will be the first person to tell you you don't need to have the world's highest IQ to be a tremendous success in the stock market, but you do need to have the temperament to be able to hold through good times and bad to make money over the long term. A lot of people find themselves highly emotional when it comes to watching their money oscillate up and down in the stock market, and they tend to chase prices up at the worst possible time, and then they tend to liquidate their holdings after the stocks go down, and they do that repeatedly. It's hard to make money over the long term. I'm not saying it's impossible, but it's just quite difficult. So, so much of this business does revolve around having the proper mindset, the proper temperament, and where that comes from in a lot of cases is from knowledge and experience. The more that you have experience and the more knowledge that you have regarding expectations, the more you can kind of flush the emotions out of your system. Now, you'll never be completely emotionless, but you can at least kind of push emotions towards the side and understand how to act within the market, whereas somebody who just started investing or trading probably doesn't have the ability to do that, and they're more prone to kind of knee-jerk types of reactions there as well. So anyway, U.S. Treasury yields continuing to rally to multi-year highs. Really, we're at the third highest point in the last decade for Treasury yields, as I was explaining to my class here today. And that's happened basically with the snap of the fingers. Remember, it wasn't so long ago when we were talking about big portions of the world with negative interest rates. And even in the United States, we were talking about 1% rates on our 10-year. Now, all of a sudden, we've tripled that all the way up to basically 3% here. So it's been really interesting. Now, naturally, when the yield environment continues to increase, the opposite is happening to bond prices. Bond prices have continued to go down as their bond yields have gone up. And so you can see that, time after time after time, TLT has been producing these oversold cluster signals. Those used to mean something back in the day. But more recently here in the last 3-month time period, I kind of equate this to the boy who cried wolf. You cry wolf too often, and then all of a sudden when the wolf actually does appear, nobody believes you. So same thing here. TLT has been basically saying I'm oversold, I'm oversold, I'm oversold, and yet the chart just keeps on going lower and lower and lower. Eventually it will be oversold. When that will happen is anybody's guess, but without a doubt you are seeing that across the bond market. Lots and lots of oversold conditions there. Bitcoin is back above 40,000 here. End of the day, closer to about 41,000. It's back to a weekly bullish posture, but it's still trading below its 30-day moving average. When it comes to the foreign securities, there is quite the difference in foreign securities here today. With EFA, which represents developed foreign securities like Europe and Australia, Japan, we actually had a pretty decent day. We were up 0.47%. But notice what happened here in the emerging stock world. Those BRIC nations, Russia and Brazil and China and India, those more up-and-coming areas of the world, their stock market struggled today. We were actually down 0.5% in the emerging stock world, and that's a little bit peculiar. Remember, typically, if you have a big up day in the United States, the emerging markets are kind of hypercharged. It's kind of like the way that you think about NASDAQ stocks versus Dow Jones Industrial Average stocks. The United States is the big, bulky, very liquid financial market out there. And the emerging markets are kind of the scrappy up-and-comers. And when you have a big, aggressive risk-on day like we had today, typically you find that the emerging market stocks actually do quite well. So this was quite peculiar that not only did they sit out the rally, but they actually lost investors' money today by 0.5%. And some of that may be because of the ongoing COVID problems that is taking place over in China. Let's also take a look at the Sector 12 grid now. This will be chart 5C here. All right, so as we're looking at this, you can see that things have improved considerably from a posture perspective compared to what we had been used to recently. You'll notice that there are now only 2 pink charts on the board. One of them is dark pink, and that's the chart up at the top, and that's the financials. As mentioned before, they've really struggled here in the last 3 weeks or so, really since that day that I pointed out there on March 29th, where they closed in the lower half of their range when all the other sectors closed at the high of their day. Financials have been in a really difficult selling spiral here. Now, the last 2 days have been a little bit different. We have started to get some financial reports out from JP Morgan and from Goldman Sachs and Wells Fargo, and all those big banks, typically lead the earnings parade. So, perhaps the worst is behind them, and we're seeing a little bit of a relief rally here. But still, we're below that moving average, and we continue to have the strongly bearish trading posture on financials. As mentioned before, if you're looking for long-term investments, that's a different story. But if you're looking to trade them in the short term, this is still an uglier looking chart compared to what we are seeing elsewhere. The other pink chart is the one in the lower left-hand corner, and this is healthcare, but in this case, notice it's a light pink color as opposed to a dark pink. So in other words, if you right-click on it and you go to maximize sell, you can see that this green line is here at the 68th percentile, so it's above the 50th percentile. So while it is kind of rolling over a little bit, it's not aggressively selling off. And I think that makes sense. I mean, if you look at the chart of healthcare and then compare it to financials, they do not really look the same, right? Sure, they both have some bearishness in the past week or so, but financials has been a little bit more ongoing weakness, which you could get away with saying for the last couple of months. Whereas healthcare put in its bottom right here on February 24th, and since that day, you've largely seen bullish trading out of it. It's true over the last week it struggled after getting that overbought cluster signal there, but it's still trading above its rising 30-day moving average. So I don't think we want to throw away healthcare just quite yet. It might very well use this area as a support bounce area for all I know. But the good news is all the rest of the charts are green. And of course, as mentioned before, energy was really your only down area of the day. XLE was down 0.81%. Every other one of these charts finished in the green here today. Now, you can see what type of an impact a 0.18% down move on XLE makes. In other words, you'd have to squint pretty good just to make heads or tails out of it. It hardly even impacts that strongly bullish trend that is in place on XLE. You can see that oil and gas stocks are up about 25% despite today's pullback over the last 3 months. And when you're looking at these little bubbles to the right of all these miniature charts, your second place candidate isn't even close to it, really. Utilities have done very well in the last couple of months, but over the last full 3-month period of this chart, they're still only up 10%. So, they would have to basically double that performance to get in the neighborhood of what's happened with energy. That's how big of a lead energy has had in the year 2022 compared to everything else that's out there. But, if you're looking at all those other charts, you are starting to see a few more positive ones pop up. So, over the last 3 months, you do still have positive gains from healthcare, from consumer staples, from utilities, from real estate, from energy, and from materials. I think, all of the rest are negative. So it's kind of interesting how that shakes out. Basically, if you were to kind of, go from row to row to row, starting with the materials right here, moving to energy, and then the full bottom rung, those are all positive returners over the last 3 months. Everything else, which unfortunately includes some of the biggest growth areas and the biggest market cap areas like technology, discretionary, communications, they're all on the negative side of the coin. And the one that's doing the most poorly over that time period actually is communications. And remember, unfortunately, that's where Netflix is housed. So it's not going to help them out in their cause tomorrow either, as communications stands a very good chance of finishing lower in tomorrow's session unless there is a monumental reversal. So we'll keep our eye on that situation there. But obviously, a very strong day across the board. Looks like our biggest winner, by the way, today was actually consumer discretionary. It was up 2.9%. So, that's going to be your Home Depots, your Amazons, and your Teslas. And I had mentioned Amazon and Tesla specifically when we were looking at the heat map earlier as being big movers here today. And so I'm sure that helped XLY quite a bit as our biggest winner from a sector perspective today. All right, let's get into our trade application example. As I hinted at before, it's going to come out of the industrials sector. And you can see industrials were up about 1.8% and got back above that rising moving average with today's move there as well on XLI in general. But the stock that I'm going to bring up is actually not part of XLI. It is an industrial, but it's so small that it's not in the S&P 500. Remember, XLI only contains industrial companies in the S&P 500. But there's a little known farming or agriculture related stock that I've kept my eye on over the years as somebody who grew up in the middle of the country in rural South Dakota. Know my way around a farm as I've spent quite a bit of my younger years on there. That hasn't been the case here recently as I now have lived the last couple of decades outside of the Midwest, but it's still near and dear to my heart, and so I like to keep my eyes on the agriculture trade and the farm trade, especially when we're in an environment like we are right now, where commodities prices are going bananas to the upside, and a lot of ag-related stocks are doing quite well. We've talked about stocks like Bunge and Archer Daniels Midland in my various presentations as just a couple of examples there. But tonight I want to, and also I remember in this very video here a month or so ago, I brought you guys that Corteva trade example, and I think that one went out at max gain for those of you that might have taken that trade as well. Remember, Corteva was the seed company, and fertilizers, different things like that have done well with CF Industries doing pretty well, Mosaic doing pretty well. The farm trade is hot right now, but one stock you probably don't hear a lot of people talking about because it's so small is Lindsay Corporation. And this is a company that if you've ever driven through the middle of the country here in the United States and you've looked out, in Kansas or Nebraska or South Dakota or North Dakota, or these areas that have hardly any people whatsoever, but just miles and miles and miles of farmland, and you see water being sprayed at a distance, those are those machines that kind of kick out the water are built by folks. And this is a company in the machinery industry group, but is one of those companies that helps water crops out there. And so this is Lindsay Corporation, ticker symbol LNN. And it caught my eye here today because it is bouncing up and off of this rising moving average. So it's not entirely surprising that it was up today. Remember, the whole stock market was up for the most part today. This one did outperform. It was up over 3% today, so I did like the look of today's candle as well. You can see that its daily range was a bit more aggressive than its average true range. So this one was an aggressive up mover, and it had a pretty steep pullback over here. Keep in mind, again, this is a small company that doesn't trade a whole lot of shares out there. Today, the total amount of shares was 69,000. So this is not for the faint of heart, right? Some of you might have a rule that says, hey, I'm only going to trade stocks that have at least 250,000 shares traded per day or something along those lines. So I'm not here to say that this trade setup is right for all of you, but for those of you that have maybe more flexible rules around the amount of volume that you require out of a trade, then I think this represents a pretty interesting chart of a company that had an aggressive pullback to its rising 30-day moving average and now has stabilized around that 30-day moving average and now has attempted to push up and off of that moving average. You'll see that where we closed with this stock today would bring us all the way back to this candle in terms of, where have we gotten back to, right? Because these candles right here close near the lows of the day. So where we closed today was actually the highest closing price on this particular stock since April 1st. So, it's kind of in the penalty box there for a while, but now it's kind of giving you the impression that it wants to take off again and play a little bit of catch up with some of those other agricultural names that I rattled off there a moment ago. You can see that despite that, 4-day pullback that we experienced back here, it's still easily a market outperforming security. This S&P 500 dotted line gives you a general sense of what the broad market indices have been doing. And since this company's price candles are above this dotted line, it's basically saying that this is a market beating security, at least over the last 3 months of this particular chart here. You can see that from a swing trading perspective, you've kind of got a green light to take a bullish trade with that background color changing to blue here because that near-term posture is now bullish with this blue line on the market forecast down below. Not only that, but this green line, which is not as important for swing trades, but nonetheless might be useful information for you, that green line, that intermediate line, is also now rising. You can see that in the label. It's at 64 and rising at this moment in time. So whether you're an intermediate term trend trader or a short-term or near-term swing trader, you do have bullish postures in both cases right there. And I think that bodes well as well. And you can kind of see that I've got the brackets set up on this particular short-term swing trade where I would be putting our stop loss a little bit below yesterday's low, and then we'd be aiming for this upside potential up here that would cross through the highest candles of the chart back here at the end of March. So if it turns around and this thing isn't the next great agriculture trade, then we'll be stopped out before we lose any more. But the hope is that it's gathering itself on that rising moving average and is now about to play a little bit of catch up and launch back up to those higher levels that it was trading at before it announced its earnings over there. So if you like irrigation companies, or if you like farm plays or agriculture plays in general in this higher commodity era that we are finding ourselves in all of a sudden, then perhaps this is an interesting choice for you. But again, be cautious around the idea that this is a smaller company that does not have a lot of volume out there. And so some of you might need to pass up on it for that reason as well. So I'll let you decide in that, but hopefully you found it to be an interesting example as I did here. So that's what I had for you here tonight. I hope you got value out of tonight's video. As always, if you did, I ask one simple thing out of you. Click like for me there on Twitter. As long as we're up and over 100 likes again, I'll try to bring other interesting trade examples to you when I'm scheduled to do the video the next time on Thursday. If we're under 100 likes, then I'll just plan to do a quick hitter video, so that way it gives you a quick information about what's going on with the markets, but doesn't get into all these extra details here. So I'll leave that up to you to decide collectively, but I do appreciate you spending the time with me here tonight, checking out this presentation, and I'll look forward to seeing you all down the road. Take care, everybody. Bye-bye.